Hey everyone, welcome to the Newbie Real Estate Investor Podcast. My name is Jonathan Boyle, and here with my co-host Joey Chan.
Hey guys, Joey Chan.
Yes, and we actually have special guests, Adam Levine and Daniel. I hate to destroy the name. Edrei.
Edrei.
Okay, awesome. Thank you for being on the show, guys.
Thank you.
Thank you.
Yeah, I just wanted to mention I think you guys are doing great things. I really love what you're doing for our investor community. And, I see that you guys you're building popularity, and I just feel honored that you invited Daniel and I on your show. Thank you.
Yeah, thank you. Thank you for, saving the time and coming on with us.
Yes, awesome. So, guys, do you mind telling us a little bit about yourselves and, how'd you guys get started in real estate?
Yeah, I'll start. So I started probably around 2012. I've always been involved with my family, my father, watching him invest in real estate actively. And then around 2012, he started passively investing. And that's when I started working for a developer he used to invest with. And that's when I decided to take the leap to go for my master's in real estate property management at Drexel. And it's a great experience from learning, at a graduate level. The only caveat is that you really can't buy experience. And I worked a lot, but it still wasn't enough. So I met Daniel probably about 5 years ago. We were working on a deal together. And then I discovered that he actually invested with a developer my family invests with. And I was like, oh, that's really interesting. And I knew Daniel, he manages his family's money, started as a lender and then as a passive investor with other developers. And I wanted to pick his brain on how he actually vets a developer, like the whole process. And then I wanted to understand his knowledge on that sponsor or that company that we invested with. Started a new entity called TCS Anika Homes, where he partnered up with one of the largest real estate families in America to create a similar model to Blackstone, where their goal is to buy thousands of single-family homes with an end goal to turn it into a REIT. And I was like, wow, that's amazing. So my goal was to basically work with Daniel, invest with him, and learn with him. And the one thing that really kept me very interested in working with Daniel was just his demeanor. He's very humble. He has integrity, ethics. He's not a blowhard like a lot of the other investors out there. Apologize for the noise. They're doing landscaping outside. But it's very rare, as you guys know, to find humble investors in this arena that we're in. And that's one thing that really attracted me. And then just the ethics and the experience. And he has all the qualities that I'm looking for. And that's why I feel just very humble and blessed to be able to work with someone like Daniel.
Daniel, can you give us a little bit about yourself, how you actually got started in real estate? I know you've been investing for a while. So, just give us a little bit of background about yourself. I know Adam kind of, gave us a little bit about what you do. But how did you get started, Daniel?
Sure. Well, first of all, thanks for the opportunity to join this webcast. Adam, thank you for blowing up my ego. I don't know how long I'm going to stay humble if you keep throwing comments like that at me. But in any case, so I've been investing in real estate in one way or another for over 25 years. I started as a bridge and mezzanine lender in the early 90s with a family company called Corp Capital Markets. We ended up in the downturn of the economy in 2008. We had an enormous amount of defaults. And the interesting thing is we learned that our mezzanine loans, where we were very high leverage, but had really underwritten our properties more rigorously, whereas we were investing with the best sponsors in the best real estate in the best locations, had very few defaults, and our lower leverage, below 50% leverage bridge loans had a lot of defaults because we weren't as rigorous in choosing, the sponsors. We were, basically counting on a low leverage. So I started shortly after the downturn of the economy in order to find yield in a safe manner. I started a product which was a dequity product, meaning a combination of debt and equity. It was an equity product in a priority position in the waterfall where we would get a preferred rate of return first, and then we would do the equity splits, and the sponsor would get a little bit better return than normal pari passu type equity. Started Anika Equities maybe 6 years ago, which was an LP investor, just because my dad was, slowing down. He's in his 70s, and I was winding up. And it was with the same group of investors as before. And then recently, in 2019, I got the opportunity to meet with Ben Aller and his partners and to form TCS Anika Homes, which is a general partner at GP investing in single-family residential properties, affordable housing only, in the Philadelphia area. Adam had the opportunity to invest in Fund 2, and now we're launching Fund 3 in about a month or a month and a half, which Adam has a position in as a limited partner as well.
You gave a lot of terms that I would say a lot of the newer investors may or may not know. GP, LP. Can you explain that a little bit, Daniel?
Sure.
What is a general partner versus a limited partner? What the difference is between the two?
Sure.
Yeah.
So a general partner is the sponsor of the deal. He's the company that is doing whatever value add operation and so on going on on the property level. An LP is a limited partner. These are traditionally passive investors, whereas they're not on the day-to-day operations. Sometimes, as in the LP investments that I've done, LP investors have all major decisions run by them. More often than not, they're completely passive.
Another term that you mentioned before equity split was preferred return. Would you mind elaborating on preferred return and maybe debt versus equity a little bit? Adam, if you want to take that one out, I'm not sure.
Yeah, preferred return is basically really debt disguised as equity. In a nutshell, where you're going to have, Dan, maybe you want to explain it a little more.
Sure. So preferred return is a rate of return that's awarded to the investor before any additional returns go down the waterfall, meaning the sponsor first pays to the investor the preferred return.
Okay.
So it's in a priority position.
And then just for the audience to be clear, so they get their preferred return first, and then it comes to whatever everyone else has agreed upon, either it be more debt or an equity split.
Correct. And just to clarify also, I mentioned the term waterfall. So it occurs to me that maybe that's not understood. A waterfall is the priority of the return for the investment. So many times, preferred return will be the first level in the waterfall. And then after that, there'll be different hurdles, different equity splits, depending on that waterfall.
Do you prioritize paying your debt first before you pay your equity investors?
So the debt always comes first.
Right.
So Adam mentioned that preferred rate of return, or a pref, comes first. It comes first in the equity stack. So before the equity makes any money, the senior lender in the first position, debt, will get there. Then second to that, if there's a preferred rate of return to investors, they're second in the waterfall, and then after that, whatever the splits are.
And it could get very complicated. You keep it very simple, or you could really chop it up a million different ways.
It can get very complicated, and I've seen some waterfalls which have 5, even 6 different hurdles and different splits. whenever possible, I've always been somebody that likes to, keep it simple, stupid, so,
Yeah.
so I'll have maybe, if there's a preferred rate of return, there's one preferred rate of return of priority position, and then the splits afterward.
That makes sense. Yeah, I actually had to do that, or I did that with one of my. It wasn't like a larger project like you guys do, but it was actually for a flip because it had enough meat in the bone that we were able to discuss that and enough partners on it. So I definitely get the idea.
Really, what you're doing is you're assigning for each level of risk a return that's appropriate. So the first risk, usually the investors are putting up to 90% of the equity. So they're in the highest risk position, and therefore they get the first, return often.
Yeah, that's a great way to put it.
Guys, I guess just moving a little bit forward now. What are you guys doing today in real estate? And has COVID-19 really affected you guys?
So we closed fund number 2, which, it was 15 properties. What I did, so a little bit about what I'm doing that's a little bit different in this environment, is that to invest with Daniel directly, you would have to invest a larger denomination. So investors could invest with me with a smaller amount, and you have an opportunity to learn with me as well. To invest with Daniel, you get a monthly report. You're more passive. With me, you're more involved, right? I have a mastermind group. It's only a select few investors. It's growing, and you don't have to be involved, but I always encourage it to, hey, learn. You should. It's very interesting, and I talk to Daniel daily, what we're doing, and so I'm having monthly, or not monthly. Weekly Zoom meetings, and we're going over the investment. That's what we're doing now. And it's very interesting what we're doing with fund number 2, and it's exciting. And now we're launching fund number 3, and to talk about what's happened in this environment, COVID-19, it's like the perfect storm, because now the underwriting assumptions prior were good, but now it's even better. We're talking about acquisition, short-term distress, where our pricing, our basis going in on acquisitions is lower, and the long-term fundamentals for the demand that we're going after in terms of a residential rental, workforce housing is greater. If anything, there's going to be more demand for our rental product, and so it's really now's like the perfect opportunity. If you're sitting on the sidelines, to actually get in now, because I missed it the last recession. I was still in college. And now I'm like, all right, well, I have the knowledge, I have the relationships, I'm ready to go. And this is an opportunity of a lifetime. That's what they're saying.
No, I get it. So to clarify, just for the audience, you're doing this fund for several single-family row homes in Philadelphia, correct? Or is it something more now as well?
So fund number 2 is just 15 homes, but we're just doing it deal by deal.
Okay.
So fund number 3, I'll let Daniel get into it, since it's his. He's the one that putting it together. He can explain it probably better than me.
Sure. So just to clarify, we've broken up each one of the funds into anywhere between, say, 15 and 30 of these row homes. The reason why we keep it small like that, even though we have an appetite to buy thousands of these units, is because we have a line of credit with our lender, and as per the line of credit, cannot have bridge debt and term debt on the same borrower. So we had to break off little bite-sized amounts so that I can finish the renovations. Once a tenant vacates, I can finish the renovations and refi that whole portfolio, rather than having to wait for 100 or 200 units to be completed.
Mm-hmm.
And in that way, we can repatriate equity in a much quicker time, which greatly increases the internal rate of return to the investor and makes the investment more interesting.
Yeah, it's actually, I'm excited because, we went from, 24 months of return of our principal capital to 12 months. So you can just keep on recycling that money over and over again, which is really
BRRRR method. So the BRRRR method is is build, renovate, rent, refinance, and repeat.
Exactly.
the BRRRR method at a massive scale, pretty much.
Right. That's a pretty unique way to put it. A large scale burn.
Nice. I'm assuming it's also beneficial that it's in bite-sized pieces because there's more of a pool of people who want to purchase, like 10 to 15 row homes rather than like 100 or 1,000, right? I mean, like for smaller investors.
Well, so actually the way that we structure each one of our funds, it's a number of investors. So I could easily raise more money for a larger fund and then break it into smaller borrowers. But I'm modeling each fund based on my current appetite. So I know right now I can buy 20 to 30 homes in the next, say, 45 to 60 days. I'm not raising money for buying 6 months from now. I'm raising what I know I can purchase here in Philadelphia immediately.
Now, I guess I could be wrong with what I've heard about what's going on in Philly right now due to COVID-19, but has that actually negatively affected you? Because I know my understanding is that all construction was halted or something.
So there are certainly some pros and cons to the current crisis that we're in right now. Number one, as you mentioned, all construction is halted. That means you can't get permits to do anything. As per my lending requirements, I need permits on every job. I can't do anything without permits. That's slowed things down a bit. In the meantime, also, there are a lot of people out of work that are unable to pay their rent. That's another challenge based on the crisis. However, the crisis has created some opportunity as well. One of these opportunities is just as a result of the pool of buyers being much smaller now. So because people are struggling to pay their rent, there's less of a demand from the less sophisticated investor. A lot of lenders have backed out of the SFR business, SFR being single family residential. So there's a smaller pool of money to buy right now. And then it's just a matter of supply and demand. So if there's a smaller pool of buyers, prices go down, right?
No, of course. That definitely makes sense. I mean, I know Joey recently bought a property at I think a $30,000 or $40,000 discount because of the crisis. So imagine that at scale.
So we're seeing probably as much as 20 to 30% off of what we would be paying a few months ago.
Wow. That's tremendous.
So it really is a very interesting period. Now, so everybody's got an opinion, obviously. Mm-hmm. My opinion on the current crisis is that different than 2007, our economy had some very strong fundamentals in it before, the corona scare. What I think that means to us is that we probably, in my opinion, we won't be in a long drawn out recession. My expectation is that it will be a recession on the shorter side. And although we probably will not come up immediately to the kind of highs that we had several months ago, because there probably was a need for a correction of some sort, I don't think it's the kind of correction that will be extended for years. So, we have a limited amount of time to buy at a discount, and I think that the market will rally shortly afterwards.
Okay, yeah, that's great. That was actually one of my next questions was where do you see the market going? So definitely makes sense though.
Yeah.
And just to jump on a little more on that is that there was for what we're doing is more affordable workforce, and if anything, there was a huge demand prior, and we're doing something that's socially responsible. We're bringing a very good quality product in the area that actually needs, and there's going to be more of a demand. So as an investor, there's an opportunity to really build up your rental portfolio. And if you look historically what Blackstone did, I mean, they bought thousands. And so that's why I'm very excited to partner with Daniel and his partners on really building this private equity firm, buying up thousands of these with them, because it's just there's such a strong demand, and it's definitely something that is less risky that I mean, it's probably the most recession resilient asset class that I could think of at this current state, and that should be performing, it should bounce back quickly, and should perform well long term.
Right.
Absolutely.
So just to piggyback on that, so I have been over the last few years focusing exclusively on affordable housing. I've done a lot of luxury product, but as of a couple of years ago, I saw the writing on the wall and started to focus exclusively on the more affordable product, for the reason that when there is volatility in the market, when there is, in times of recession, the product that does really well is not the luxury product, which is more volatile. It's the affordable housing. Many people will have to downsize their units from more luxury properties down to more affordable. And beyond that, also being in Philadelphia, 25% of the population in Philadelphia last year was below the poverty line. So we're talking about a population that needs affordable housing more so than it needs a luxury product.
That's great. So Daniel, can you explain to us a little bit, how are you finding this many properties? How are you getting these?
It's it's not easy. One of the things that on Fund One that we found out was that buying vacant shells was incredibly difficult. Fighting with the world, the prices were made sense at one point, and months later were blown out of proportion because we were fighting with all the fix and flippers.
Right.
Mm-hmm.
What we're doing now is we're focusing more on purchasing portfolios of properties that are already rented. So there's a tenant in. We purchase properties that have no more than 6 months remaining on the lease. And then when the tenant vacates, we do an abbreviated renovation. Perhaps it's not a total gut renovation because we're purchasing at a higher level than a vacant shell. We're going to realtors, we're going to the MLS, we're going to wholesalers. There's a lot more properties on the market that are currently rented than those that are ready for the fix and flippers to renovate and flip.
Okay, so that's good. So you're coming in and not trying to compete with all the other fix and flippers and things like that. You're coming in trying to purchase more or less the turnkey type of properties, if you will, or maybe not as good of a condition as a turnkey.
These are properties that, in our opinion, require renovation. And in renovating it, not only do we achieve a higher after repair value, ARV, but also we get, a higher rent. So our cap rate, which is the rate of return over the cost, is much higher after we do a renovation.
What would you say your cap rates are right now in Philly?
So we're probably buying based on the existing cash flow at between an 8 and a 10.5 cap, but we're substantially higher on our after repair rate. All because of the BRRRR method, what's happening is we're receiving back often 110 to 115% of our equity within the first year through a refinance.
Wow.
So what happens is in the second year, you've already got all your money back and everything, now you're in the infinite return. But that's why, our model for Fund 3, we're expecting to be able to deliver to the investor a 50% internal rate of return and a 2.5x equity multiple.
Wow.
The equity multiple, just to clarify, is the the multiple on your invested equity. So a 2.5x equity multiple, if you invested $100,000, means you're getting $250,000 return.
What's the time period for that?
It's a 5-year hold.
It's a 5-year. Okay.
Okay.
It's a 5-year fund, basically.
We expect to hold at least 10 years. Probably what we'll do is we'll buy out our investors at the end of year 5 at market value, just because we're a long-term player. But a lot of times when you raise money for a fund, investors are looking at a 3 to 5 year horizon. That's why it's modeled as a 5-year hold.
Yeah, that's for the most part, it's very similar. Most indications are, in that time period.
Correct.
So, yeah, that's great.
So, what's really interesting too, the reason why the single family residential homes, when you're buying portfolios as well, what's really interesting is when you're controlling thousands of these, now you're dealing with operational efficiencies similar to multifamily, where you're saving on costs due to economies of scale, and you're valuing it when you sell it similar to multifamily based upon cap rates. And another reason why they're going after the single family rentals is because they don't want to compete with his partner's father. Richard Aller owns like 50,000 units.
Something like that, yeah.
So they're more of like an institutional investor where they'll go in and buy at a higher value, which is a lower cap rate, where your cash on cash yield is lower. But with the single family residential, the SFR, you're dealing with mom and pop investors that you can actually get it at a better basis, and your returns are going to be higher. And then when you're controlling thousands, now it's similar to multifamily, and this is an asset class that the institutional investors are jumping in. You have Blackstone, you have like Starbridge, you have many other entities that have everything for doing this, and now you have TCS, which is a brand new player to the market. But not brand new as an entity, but not brand new in management. The management team's been around for multiple cycles.
Yeah, well, I should say, so TCS Management is the largest scattered site management company in Philadelphia with well over 3,000 units under management. TCS Investments had done about 650 fix and flips for third-party investors, and TCS Anika Homes is my joint venture, Ben Aller and Gaurav Gambhir of TCS brand, and that's our joint venture together.
Jumping into Fund 3, right? When you say that Fund 3, it's open now, right? It's open for new investors to come in and invest. When you say it's open versus it's closed, like for example, Fund 2 said it's closed now, that means the fund is fully funded, just to kind of give our audience, right? So Fund 2 being closed means it's fully funded, and now the process is going to start taking place. Is that what it means?
Absolutely. Fund 3 right now, we've raised enough to buy 20 properties. We'll probably increase it slightly to 30 or 40 properties, so we'll still accept some investors at this point. But understand, every couple of months we're running a new fund.
Okay.
So we're in a very large acquisition phase. We like to do at least a few hundred units over a 12-month hold, but these are broken into smaller portfolios of anywhere between 20 and say 50 max.
What are you guys looking for exactly from an investor if they wanted to invest in your fund, let's say? I know you both have two different ideas, but yeah, sorry.
Absolutely. So the number one thing is they need to be accredited investors. And what that means, we have on our website under the investor portal something that they can click which says who may invest, which talks about what their annual cash flow or their net worth needs to be in order to invest. This is important because we're not a broker dealer. We can't reach out to anyone. These have to be blue sky accredited investors.
And it's very simple. Like it's a form. Come to Daniel or myself. We'll email you the form. You just sign off saying you're accredited. That's it. So it's not like a long drawn out process.
And there's a description of what that is. And, we don't verify all of that data or self-attesting to that you're an accredited investor as per the act. And that page describes exactly what an accredited investor is. It's a pretty low bar. It's a $200,000 in annual income and a net worth of $1 million. So it's not, a very high bar that you have to reach.
Yeah, it's 200,000 annual. If you're married, 300,000 combined. The $1 million net worth, but not including your personal residence.
Correct.
But yeah, it's definitely achievable to do.
Adam, what kind of investor is your fund accepting that makes it a little bit easier for the people kind of starting out, let's say, to invest?
Very good question. So right now, I'm accepting only accredited investors. I'll talk with my counsel ways to accept non-accredited, but I'll leave that up to the legal professionals. Not going to, I'll stick to legal. However, what I'm doing differently is, for me, I struggled with this my whole life. I was trying to find, I always wanted to learn, but also invest. And, there's a lot of gurus out there you just have to be careful of. And so I'm trying to deliver. Joey's laughing. There is,
Yeah, you're right.
Very careful. I was leaving it at that. But for me, fortunate, I met up with Daniel, his partners. I love the business plan. And what I want to do differently is say, hey, there's a lot of people like yourself that want to learn. But so by investing with me, you could invest a smaller amount of money, not six-figure check that, TCS requires. You could invest a smaller denomination, and also you could learn. I mean, like I have one of my partners, Tay, Daniel knows him. He's a CFA, he's a CPA, and he works a full-time job. He used to work for Goldman, now he works for Prudential. And very sharp kid, very, very sharp, but, he wanted to learn. So he invested with me in fund number 2, and he's learning a tremendous amount. I mean, every day, we're almost on the phone almost every day going through the documents. In fact, we have a phone call, Daniel, I believe at 1:00, where we're having our investor reporting to go on for what's going on with fund number 2. That's something that we get that, most investors, I don't know any other management company that does that, what I'm doing. Usually when you invest with a sponsor or a company, it's once a month. That's all you get. With me, we're going even further. We're going over joint venture docs. We're going over mortgage documents. We're going over all the HUDs, appraisals, the models, running numbers. So you're actually learning at a very high level. And that's the type of relationship I built with Daniel. And and I know you're the newbie investor. So what I can say is, if you want to get started, it's always good to invest and learn, but you really want to be careful on who you learn from. You want to pick the right people to learn from. And that's what I did. I struggled with it, and I'm very happy with the relationship I built with TCS and Daniel.
By the way, the structure that Adam's implementing as an LP investor in TCS Anika Homes for the newbies, often referred to as club investment vehicle. So Adam's firm, Levine Capital Management, is an investment club.
Okay.
It's simply put, these are club deals I'm doing. I'm basically, aggregating capital to meet the minimum investment with Dave.
Okay, got it. So it's kind of like Adam's kind of like your sub in a sense, if you were going in contractor speak or whatever.
Yeah, sure. In a way. I mean, so
in a way, I don't mean specifically. I know Adam has his own fund and it does other things, but I'm just saying in general.
My minimum investment is typically $200,000. Yeah.
Okay.
And there have been times in the past I've accepted $100,000, but I simply cannot. I do not have the time or energy to deal with smaller investors than that. And Adam does, have the time and the energy. So he'll come in as my investor, and under him, all of his investors will, be pulled together.
And I'm very passionate. I love it. So I actually, I love to help people and teach and learn and go through it. So that's the one bet. I mean, by all means, you don't have to be involved, but I'm there. And then, Daniel will get involved as well with us. And I have a mastermind group on Facebook. You could join, it's exciting. And right now it's like the beginning stages that we're launching. We just did fund number 2, and now we're launching fund number 3. And so we're at the very beginning, which is a very exciting time to get involved.
Absolutely. Yeah. I think it's a great way to come in if you don't have, 200,000 plus to invest. If you have, like, let's say 20, 50, which, a lot of people do have that amount. So this
Let's
is
talk
great.
about it for a second.
Yeah.
So those also that have the 20 to 50 to invest that might look to do it themselves,
Mhm.
even assuming that they had the experience that our group had with, the buying, the renovating, the leasing, the management, so on. By investing in one property, your risk is much higher than investing in 20 to 50 properties. The reason being that your risk is diluted over a portfolio. So you're always going to have one or so properties that go over budget. One property where you have a nightmare tenant that doesn't want to pay his rent. You can have problems on one or two or three properties, and your risk is completely diluted when you're investing on 30 properties all at once.
That's something that actually I stressed to take is he wanted to learn with someone he was telling me, and I was like, well, you're investing with one property. I mean, and then one little hiccup like this pandemic can blow up your whole investment, you know. Fund number two, I mean, granted we closed and now this hit, but we're okay. We're still positive. We still, we're collecting, what was it, like 70% of our rent. So we're still cash flow. Versus if that was one house, we could
Yeah,
be.
you're done.
Yeah. Yeah.
It's important to note, even with the very experienced professionals that have been doing this for many years, when you're renovating a home that's 100 years old or more, until you start opening up the walls, you don't know what you're looking at.
Mhm.
So even the most experienced are going to run into some issues with overages on, a handful or a spattering of property.
Where can people find you guys? Let's say on social media, things like that.
So I'm trying to get more active on social media. I'm kind of shy, but trying to be more out there. And you can find me, Adam Levine, not to get confused with the singer, right?
Yeah.
Levine Capital. I'm trying to work on my SEO. LevineCapital.com. You can reach me at adam@levinecapital.com, or really easy if you want to find me, just reach out to Joey or Jonathan. Daniel, he's very easy as well.
So I am at TCS, Thomas Charlie Sally Anika Anika Homes.com. You can go and on the website to the investor area and request a password and get an offering memorandum that way. I'm on LinkedIn. I'm on Facebook. I'm not as active on social media as Adam is. I'm a little more, I'm a little older and crustier, and and not as focused on something which I really should be. But that's why I have guys like Adam, working with me.
That's what we're doing. That's why we want to get on these podcasts. To try to build the momentum, the names, and we're helping each other out. Helping your
Right.
The whole idea is just to help, and that's why I work with Daniel, because the idea is to really help people. And I know this, like I said, this is a very strong, something that people need, so that's why I'm trying to get more active to try to spread the message. And we're living at a time now where Facebook, LinkedIn, Bigger Pockets, these are amazing YouTube, these are Instagram, these are amazing tools that you can use to really build your brand and spread your message.
Absolutely. Just want to let you guys know there's also a new platform as well that I just got on. It's called Web Talk.
You're on to me, I think.
Yeah, that's right. Yeah, because Stefano actually originally invited me, I believe.
I think Jonathan, I think you're underneath me too.
Yeah.
I got to get more on there because I know you guys are going to build up a big social media. So,
Yeah, I got to start working on that one as well. So
Same here.
and I can benefit from it or something. I still try to figure out this platform. I don't really fully understand it, but it seems interesting.
It looks very similar to LinkedIn.
Yeah.
Yeah. So
You guys pay for it? Because I know
I have not.
no, I haven't yet.
Yeah, I'm thinking about it. I don't know if it's got but it's interesting.
Yeah.
I think it's still too new
Yeah.
right now for me to really put some money into it yet. You know, once they have like millions of followers, then I'll think about it. Right now, it's still not there yet.
I should encourage you to do it because then I benefit because you guys are like, thank you so much for this. This is looking to get on the more of these webinar series and hopefully at your office or our office next time. You know, this is
Yeah, hopefully once this thing blows over.
Absolutely.
Yep.
So yeah, so I want to thank you, Daniel and Adam, for hopping on this call with us, letting our audience know about your new fund coming up, and yeah, thank
Yeah, I
you.
definitely learned a lot. So, thank you. And, I'm sure we'll definitely be talking. So,
Absolutely. A pleasure. Thank you guys very much for the opportunity.
Same here.
yeah, thank you. And one last thing, by all means, like I guess ask your audience, like if they have any additional questions from us, we could always jump on and really dive in deeper into another subject that they have an interest in.
you guys know what you're talking about because I know we sat for like an hour about one of the projects. Take care, everyone.
Thank
All
you,
right.
guys.
Thank you very much, guys.